Good afternoon, everybody, and welcome to another Crypto Winter podcast interview. My name is Peter Renton, Chairman and co-founder of Fintech Nexus, and joining me today is Jonah Crane, who's a partner at the Klaros Group. And before we get to Jonah and to our conversation, just a quick reminder to everybody that Merge is coming up. This is our cryptos meets Fintech meets banking event in London. It's happening October 17th to 18th. You can go to fintechnexus.com to find out more about that. Okay, so Jonah, how are you doing today?
I'm well, Peter. Thank you. How are you?
I'm doing well. And for those wondering, I'm coming at you from a hotel room in London, where at this very moment it is 97 degrees. And we're all kind of warm over here right now. So anyway, why don't we get started, Jonah? Just give everybody a little bit of a intro and background about what you do.
Sure. So I'm a partner at the Klaros Group. We are a young advisory firm. We've been around for just over 2.5 years. And we say that we focus on the future of financial services. You described your Merge event as sort of where crypto meets fintech meets financial services. And that's kind of the universe we inhabit too. We work with everybody from startups to large regulated banks and other kinds of financial institutions. And we really work at the intersection of sort of business strategy and regulatory strategy and technology strategy, and help clients navigate what are often new and unusual challenges and sort of square peg round hole type problems. So thanks for having me today.
My pleasure. So are you working with crypto companies specifically right now? And you also traditional banks who are interested in crypto? Tell us a little bit about the different types of clients that you're working with.
Yeah, yes, and yes is the answer. So we are working with crypto companies who want to participate in the banking system. We are working with regulated banks who want to offer crypto to their customers or find ways to facilitate crypto across their businesses or the platforms that they operate. And we're working with some folks in the DeFi space as well. So it's a pretty broad range of folks across the crypto universe.
And are you typically providing like advice on how to navigate the regulatory system? Is it like what's the type of consulting exactly?
Yeah, so it's sometimes it's more strategically oriented. If we're a bank, where should we get started in crypto? How can we navigate the sort of fast-moving crypto landscape from a regulatory or a risk perspective? Where is it safe for us to get started? How can we get started and do so in a way that will be credible with our regulators? And so it's really that whole range of advisory services, from strategy down through regulatory and compliance.
Okay, so then it'd be interesting to get your take on what you've seen so far as far as this. We're only, depending on when you want to say the start of it was, the crypto winter has been upon us, not for a long time, but certainly a few weeks or months now. Have you noticed any change in, or what impact has it had on the clients that you're working with? Are people less interested in this space now? Is there being a slowdown in people coming to you? And what about so that's one part of the question. The other part is, what about the people that are already with you? What are they saying? What are they seeing, and what are they doing?
Yeah, I mean, our clients who we're working with to develop crypto offerings in some way, shape, or form are still sticking with it. We've seen sort of no diminishing appetite in that respect. And I think that's probably because the folks we're working with are doing so because they felt some strategic imperatives, an offensive imperative, defensive imperative. They were doing it for core strategic reasons because they felt like crypto was going to be part of the landscape for the foreseeable future. And their customers or their customers' customers wanted access to that. And so we haven't seen those projects diminish. I think over time we'll have to see whether the incoming slows down at all. It hasn't to date, but I wouldn't be surprised if it does. If I haven't dipped my toes into the water or started working on a project yet, I might want to wait and see how things start to play out. It is, as you say, early days. It's not clear in Game of Thrones terms. It's not clear whether like the Meisters have just sent the Ravens out announcing the end of autumn, or whether whether the undead are sort of marching on the wall. Right. We don't really know where we're at, so we'll have to see. We're just a couple bankruptcies into this thing, and often these cycles tend to there tend to be additional shoes to drop. So we'll have to see.
well, winter was coming in Game of Thrones for many seasons.
This is true.
So it took a while. But anyway, what do you think, like, as far as where we are today, and this, we're recording this in the mid to late July, where are we at today when it comes to the crypto winter? What's been the impact so far you would see on the broader space?
Yeah, I mean, the most notable thing for me, I'll make sort of 2 points, one macro and one regulatory. The macro point is just that this crypto bear market is taking place against a very different backdrop than the rest of the, every previous crypto winter has taken place, right? And the entire evolution of the crypto space has really occurred during a 10 plus year period of low to negative interest rates around the world, at least in the developed world. And I think that has shaped a lot of what we've seen, not just in crypto markets, but all markets. And so it's hard to look at this market and think that things aren't going to be a little bit different, right? Every previous crypto winter has sort of naturally evolved into a crypto spring and a summer and a relatively healthy harvest, if we want to sort of beat the metaphor to death here. But I think a lot of that was driven by, a really forgiving macro environment and really low interest rates. And we'll have to see how much of that translates through this time around, right? If, interest rates are 15 times higher than they were a year ago in the United States, and they're forecast to more than double through the end of the year. So that's the macro point, which is that this is a very different backdrop, and the speed and ultimate shape of any recovery in the crypto space will probably look different this time around. You just probably won't have as much speculation on the back end of this. Also because the damage this time around has been fairly widespread in terms of the number of retail investors, et cetera, getting hit. So I think the recovery will look a little bit different for that reason. On the regulatory side, where, as we noted, we spend a lot of time and pay a lot of attention, regulators have looked at all this as a gigantic "I told you so" moment. And I think they feel vindicated in their skepticism. They feel vindicated in their go slow approach. And I think the challenge for the industry will be that the imperative that regulators felt to start to try to bring crypto within the regulatory perimeter, to try to give more guidance and provide more clarity, any sense of urgency regulators felt around that, probably because they thought crypto is inevitable at some level, might have dissipated with this particular episode. I think the one caveat to that, the one place where that latter observation is probably not true, is with respect to stable coins, where it seems like regulators have taken this moment, particularly the collapse of the Terra stable coin a couple months ago, as a real motivator to try and move forward on something around stable coins, either regulation or legislation here in the US. So I guess those are a couple points I'd start with that stick out to me.
Right. And so then, when from your vantage point, do you see this, or what maybe I could ask it this way: what do you see as a positive that we can take out of this, particularly for the crypto industry today, as far as this, the challenges we've had the last few weeks?
Yeah, I mean, I guess it's always important to look for silver linings. It's been a challenging period, and at this point, it's hard to call it a positive, at least a net positive, for the industry in general. I think it's, but a few things. One, I think the damage has been mostly contained to the crypto space, and that has been, lucky if nothing else. If we were 4 or 5 years from now, and Wall Street was deeply embedded into DeFi, I think we might have a different perspective here. But it's been mostly contained to crypto. And it's been mostly contained to certain corners of the crypto space too, which we can come back to. So I think that helps in at least providing an opportunity for moving forward. I think there are opportunities here. That's sort of the way I think of the upside or the silver linings. The opportunities are, one, you can focus on building real products going forward. You don't have to compete with some protocol offering 19% yield and doing things that are just sort of clearly unsustainable on their face. So if you want to develop and offer sustainable, real products that have economics that work over time, you might actually have an opportunity now. I think some of the frothier projects will have not survived, and I don't know that they are likely to come back anytime soon. So at least there's an opportunity to focus on sort of building, like I said, real products. And I think there's an opportunity to start focusing more on sort of building real use cases as well. Sort of, there's this tension in crypto or chicken and egg problem, where half of the crypto world says, well, we're just building new infrastructure, and everybody else says, well, what are we building it for? And I think there's a real chance to sit down and say, okay, what use cases do we want this new infrastructure? Do we want these new rails to support? And to build for that, to build for those use cases. I think financial infrastructure is almost very rarely built in a vacuum, and so I think this is a good opportunity to reset a little bit and to say, outside of pure speculation, what are we really building for? And how do we build infrastructure that's tailor-made for that? And that may be an unrealistic expectation, but I think I'm at least hopeful that parts of the industry will take advantage of this moment, take advantage of their ability to, again, build real products without competition from unsustainable offerings out there. And then, narrowly, I keep coming back to stablecoins. I think there's a real opportunity for the industry to coalesce around standards for stablecoins. And the regulators or Congress will do so if they don't. So I think there are a bunch of opportunities here, and if there's a positive coming out of this, it will be because the industry took advantage of this period.
Right. Let's hope so. So for those people that are watching this live, feel free to ask a question, hit the Q&A button to join in. But I wanted to just touch on a lot of the problems that we've seen, maybe with the exception of Terra, have been the recent problems are in the centralized exchanges that were doing lending. Like obviously we saw Celsius. I mean, BlockFi has survived, but is basically a shell of its former self, I think you could say. But so then you hear on all of the crypto. Crypto chatter on Twitter that people are saying, well, DeFi has survived. I mean, Celsius famously, basically, it closed out its position so it could access the collateral that it had on some of the DeFi platforms. So do you think that this is really, I mean, is the damage like the damage that's been done? But do you think this means that DeFi has kind of proven itself to be more resilient?
So, time will tell, I suppose. I think a couple things. One I already mentioned earlier that I think at some level the crypto sector was a little bit lucky that in terms of timing that the damage has been largely contained to the crypto sector itself because it wasn't super interconnected with the broader financial system. There was enormous amounts of interconnection as we've seen. Within the crypto space. And I'd say to some extent that crossed over between, the centralized and DeFi worlds. You mentioned Anchor. Celsius had large exposure to Anchor. So did, Voyager and 3 Arrows, and they all had exposure to each other. So you had this sort of circular, interconnected, really chain of leverage. And that's just sort of classic financial stability risk, but it was limited to the crypto sector. I'm not sure it was entirely limited to centralized sort of players in the market, but the big thing that differentiated the centralized and the DeFi players, at least to me, in particular as it relates to lending, is that in the DeFi space, we really hadn't moved from fully collateralized and over-collateralized lending into under-collateralized or uncollateralized lending yet. I think to some extent that, saved the DeFi space for now. I think those are just very different things, of course. When over collateralized lending is really an exercise in your ability to assess the risk of the collateral and ultimately to liquidate the collateral if things are not going well. And I think DeFi is well set up to do that sort of thing, right? That's precisely the kind of thing you can put into a smart contract and expect it to execute on. I think a lot of folks in the DeFi space have aspirations to, move beyond fully collateralized or over collateralized lending. And I think how that all is going to work in DeFi is a big question mark. And if you had DeFi protocols who were trying to do the same things that Celsius was doing, it's not clear to me that it would have ended any better. So I think it'll depend a lot on where DeFi tries to go from here and how they try and do it. If they move forward learning the lessons of this particular episode, I think they got a chance at doing it better. That's for sure. But it's a very different ballgame to move into the more traditional sort of credit type world than they've been inhabiting so far.
Right. So then I'm curious to sort of take a look at the traditional financial systems, particularly the banks, many of whom have started this road exploring. I'm sure some of the ones that you're talking with are in that exploration phase, but I'm curious to know where we go, how we get from where we are today, because some of the technology that has been developed is extremely, it's fantastic technology. It's more efficient. It helps. I think it has the potential to cut costs and make things quicker. But where do you think, where do you think banks should be getting involved, and how are they getting involved to sort of, as we move into, I mean, my premise is that we are going to move into a world where there's a lot more of this sort of blockchain technology in the financial space. But how do you see banks evolving into that world?
Yeah, I mean, it really depends on what bank and what kind of bank you're talking about. So, I think there's sort of the whole retail side, and that's one aspect of all of this. And I think, banks will probably be a little bit slow to get involved on the retail side for obvious reasons, or at least they'll be limited in their approach. I think then there's sort of the payment side of things, and we've seen banks join a consortium with Figure to really develop a stablecoin-based payments network. And I suspect you'll see more banks interested in how they participate in any sort of crypto or blockchain-based payments platforms, because that's an important piece of the banking franchise. And if that's going to evolve, they'll want to be part of that evolution. And then there's really the whole capital market side of things, where the larger banks are having to figure out, how do we participate here? And if all this trading activity is going to happen, on some decentralized rails, again, sort of how do we participate? How do we do so safely? And I suspect there you'll see, lots of demand from traditional players for the kinds of traditional prime brokerage services they're used to seeing, for the kinds of hedging instruments they're used to dealing with in other markets, and interest in things like regulated futures, which I think you're already seeing to some degree. So I think it really depends on which sector within banking you're talking about, which sort of class of banks you're talking about, and which customers they're focused on. But I think, from what I can tell, banks are really thinking about all of those things very actively. And so I would be surprised, again, if, as I said before, all of those are being driven by strategic imperatives. And I'd be surprised if banks decide to, stop whatever work they're doing on all those fronts, just because the price of Bitcoin is lower than it was several months ago.
Right. Yeah, there's two things going on here, right? There's the price of the crypto tokens, and then of course we have the companies themselves that are, there's obviously a massive pullback in valuations for the publicly traded companies. There's the, obviously Fintech is not exactly doing well in the public markets either. But there's I look at it as two different things. There's the price of crypto, and then there's the performance of the companies. Now they're not unrelated, obviously, but do you see the price of crypto as being just such a driver now? I mean, why is it, part, like I said, putting aside the companies that are going under because they made bad risk decisions, but should we be ignoring the price of crypto?
So I just always reference the price of Bitcoin in particular as sort of a proxy for the health of the industry. And I think, historically, the price of Bitcoin has been pretty correlated with the amount of investment going into the space. There are also a lot of business models that are pretty highly levered to the price of, Bitcoin or crypto assets in general, right? If you think about a trading operation, well, we still talk about the dollar volume, dollar denominated volume of trading that, say, Coinbase does, right? And so if you look at somebody like Coinbase, there are not only fewer trades happening than there used to be, but the price of those trades is a lot lower because of the price of Bitcoin. So I think the price of the assets does matter, but I think you're right to ask the question, more generally about whether we should really be focusing more on fundamentals and the underlying activity. And I think I think in that sense, a lot of the folks who are, the institutions I mentioned before, who are actively engaged in and exploring projects involving crypto somehow, are looking through the price, and they're thinking about the fundamentals, and moreover, they're thinking about it years down the road. They're thinking where might the financial system evolve to when they're trying to make sure that they are part of that. So I think they're definitely looking through the price, but it's hard to ignore the price if for no other reason than it is at least a rough indicator, a rough proxy for the health of the industry overall.
Right, right. Okay, so then what do you think are the interesting, products or product categories that are being worked on right now that you think will have a big impact on the future of finance?
Yeah. I mean, maybe just one more note on the price, since it occurred to me
Yep.
right at the end of my remarks. I mean, in a world where you have more and more leverage, the price really matters, right? And so not just Bitcoin, but the price of any crypto asset against which you've got a significant amount of leverage in the system. Prices go down, margin loans get called, and that's how you get the cascading effects we've seen. So prices really do matter in a world of leverage. So in that sense, it matters as well. But I think that's, again, hopefully we're through the sort of deleveraging phase here. At least for the time being, but again, all good lessons to take away. In terms of products being developed, I mean, I hinted only very vaguely at some of the products being developed a minute ago. I think in terms of what I would like to see be developed, I think in order for DeFi and really sort of, I guess, what's now called Web3 to develop and mature, I think we really need to start at the foundation and develop much deeper and richer digital identities. And I think if this idea that, individuals are going to, take more control over various aspects of their lives, their financial lives in particular, and be able to sort of port their own assets and their own property from environment to environment. I think it really starts with digital identity. And I think we're still pretty nascent in terms of the evolution there. So that's what I would like to see is people in the industry try to capitalize on this moment as a time to develop deep in what I call rich digital identities. And I think that incorporates, a broader range of personal data. And I think the real challenge there, as we've seen in other areas, is consumers have only sort of limited appetite to truly be in control of, their own digital identities, their own personal data. I think they want to be in control and be able to use it, but as we've seen with crypto, if you're responsible for managing your own personal keys, there are real downsides there. So I think we're going to have to really think through what's the right set of sort of primitives, if you will, to use sort of computer science language, or what are the and really at the end of the day, who are the right intermediaries there? And I just don't think you can get away from having some number of trusted intermediaries there. So this is all, like I said, sort of nascent and maybe somewhat vague in that sense, but I think it's really important to the development of Web3. And I would like to see more attention paid there. I think there are some companies focusing on this. And at the very least, maybe a narrow aspect of it is just figuring out KYC for the DeFi world. I think that would be a major improvement in terms of, making the DeFi space sort of, fit for purpose, if you will, or even make it capable of participating in existing regulatory frameworks, which I, of course, think is going to be necessary going forward.
Yeah, completely agree. And I'm also like you. I feel like the KYC space and digital identity in general is it's so key. I don't see how you can possibly scale. I don't think that any government would allow trillions of dollars to be transacted anonymously in in a space where it's just not realistic. I know that the crypto fanboys think that's the way it should be, but it's just, I don't see it happening. And I think given and I think it's a solvable problem, and I know that there are companies that are working on it directly. We had John Sun on from Spring Labs earlier, who's one of those companies that is working on it. But assuming it's a solved problem and regulators are comfortable with the KYC that's happening in DeFi, and you've got something attached potentially to your MetaMask wallet or some other wallet that you're using, what then? If we've solved this problem, what's the next opportunity?
It's a good question. I mean, far be it for me to be a market seer or a prognosticator in that sense. But I do think, I'll keep coming back to, the opportunity in front of us to sort of do a bit of a reset within the industry. And I think we've had a series of sort of, crypto winters or bear markets that have been succeeded by subsequent bubbles at the end of the day. And in the most recent case, like a series of bubbles, right? And I think there's a positive outcome to that story, which is, the bubble, if you will, the massive investment of capital has led to really the development of an enormous amount of infrastructure, which we'll be able to use to build on going forward, sort of the classical, bubble theory of technology cycles. But so that's a positive version of this. I think in order for that to come to fruition, there really needs to be some kind of reckoning, in the industry. And I've written a little bit about this recently. It's not particularly new thought, but I think one, crypto leaders in the crypto industry will have to really come to grips with the fact that they're going to have to exist within some kind of regulatory perimeter, figure out what that looks like, help regulators figure out what that looks like. As I said before, I don't think you can just sort of remove trust from the system altogether. I think at the end of the day, if mainstream users are involved, people are not in positions to audit the code, so you can't just say just trust the code. There are going to be intermediaries involved, and the regulators are going to work through intermediaries. So I think coming to grips with that is important. And as I said before, I think coming to grips with the idea that some products just aren't consistent with fair and orderly markets, and that the industry, I think, can do a better job at self-policing some of these things, right? And if you just look at the number of industry participants who had some exposure to the Anchor protocol, which I think was viewed not just in hindsight, but at the time as something sort of incredibly speculative and unsustainable. I think we need a bit of a reckoning from the industry in a sense that, okay, things like that are not helpful to the industry going forward, and we need to keep products like that out of the market. And then stablecoins, recognition that stablecoins need to be stable. And my personal view is Tether is not necessarily a trustworthy, stable asset, and yet it still underpins a giant portion of the system. So I think if, with those kinds of things in mind, I think there's a real opportunity to build something that is, again, within existing regulatory frameworks, or within existing regulatory frameworks subject to some modifications, which we've all been talking about, but not doing a lot of work building around over the last several years. And that would put the industry on a really good footing going forward, I think, to develop useful products and products and use cases that really solve real needs. So that's my hope going forward, and I guess we'll have to see how it plays out.
Okay. So last question then. This is going to be about regulators. I mean, you've spent some time in and around Washington. What do you think regulators should be doing right now? And when it comes to, thinking about this space, what are you talked about stable coins. That seems to be that there is a little bit of momentum there. But if you were president, let's just say that, what would you tell your people to focus on?
So, I'm much like my view of where the industry needs to think about, sort of coming fully to grips with what it would mean to be sort of operate within, regulatory frameworks. I think the regulators, for their part, have said for a long time, listen, we want crypto within the regulatory perimeter, or in some cases they're saying we believe it is and should be. The SEC has long said that virtually every token out there is a security, and yet we've not gotten a lot of, help figuring out what it means and what it looks like to operate as a compliant participant within those regulatory frameworks, right? And I think that is what the regulators can do to be helpful. They can say, listen, here's what it means to be compliant, or at least work with the industry to identify the areas where there are real frictions within the existing regulatory system, right? And in the securities world, there have been a few that have been identified. And things like transfer agents, but it's going to be broader and bigger than that, right? And crypto exists, has really grown up with sort of different market structures, and I think the regulators are going to have to figure out how to fit that world into the existing regulatory frameworks and achieve regulatory goals. And I think they should be showing, that they could show more leadership in that respect. And I think that's what I would ask of regulators, is to really put forward a hypothesis about here's what it would look like to be, to come into our markets and to be regulated. And then, the industry will have to figure out, how much they can do to accommodate that and where there might be frictions. I think we've been doing a little dancing around those issues for many years now, and I'd like to see more progress there. And then the last thing is, there's a big regulatory, sort of jurisdiction gap. There is no real regulator for spot market, spot commodities markets in the United States. And if I were in Congress, I would be trying to fill that regulatory gap ASAP. It's been clear and obvious for many, many years. There are now some proposals out there to do it, but there doesn't seem to be as much momentum around that as I thought. And a lot of the oxygen is taken up with things like stable coins, which, at least in my mind, don't require legislation to solve. So that's my very high level view of the regulatory landscape and how we can make some progress here. But I've been saying a lot of the same things for like 5 years. So,
right. Okay. Well, on that note, we'll have to leave it there, Jonah. Thank you very much for coming on. It's always great to chat with you. I appreciate you sharing your thoughts. Thank you for listening or for watching. And we'll be back again with another episode. I think it's coming up tomorrow. Thanks, Jonah.
Sounds good. Take it easy, Peter.